Welcome to the Deep Dive. Today we're tackling a really significant development, the new tariffs announced by the second Trump administration.
Yeah.
We've got a comprehensive analysis here looking at these proposals, what they might do to the economy, and even, some ways you might want to think about your investments. Our mission is simple, to cut through the noise and give you the crucial insights into this, evolving trade landscape.
Exactly. This is a moment that could really shift the economic playing field. As our source material details, these policies have the potential to reshape markets, influence how the economy grows,
Right.
and have a direct impact on how you manage your investments. So we're here to break down exactly what you need to understand clearly and hopefully without overwhelming you.
Absolutely. And the date that really kicked all of this into high gear was April 2nd, 2025, Liberation Day, as it was called. That's when the administration really laid out the specifics of these new tariffs. Okay, so let's dive right in. What are the core tariff proposals that we need to wrap our heads around first?
Well, the report highlights several key components. The first, and perhaps most significant, is a baseline 10% tariff on all goods imported into the United States.
All goods.
All goods. This is set to take effect on April 5th. What's fascinating here, as the report emphasizes, is just how broad this is. It really signals a move towards what's often called a protectionist stance, essentially.
Yeah.
Policies aimed at shielding domestic industries from foreign competition, across a huge spectrum of products.
Oh, wow. A 10% tariff on everything coming in, that's pretty far-reaching. Then we have these individualized reciprocal tariffs. That sounds a bit more targeted. Can you explain how those work?
Right. These reciprocal tariffs are aimed at over 50 countries, and they're scheduled to start on April 9th. The underlying idea, according to our source, is to roughly match the import duties and other trade barriers that these countries currently impose on goods coming from the United States.
Oh, okay.
Sort of an eye-for-an-eye approach to trade, if you will.
Okay, so the level of their tariffs on us will influence the level of our tariffs on them. That makes some sense. Can you give us a few concrete examples of what these rates might look like for some of the major players mentioned?
Certainly. The analysis we have gives us some specific numbers. For China, the proposed reciprocal tariff is 34%.
34%.
The European Union is looking at a 20% levy. When we look at some of our other significant trading partners in Asia, we see Vietnam potentially facing a 46% tariff.
46, wow.
Taiwan at 32%, Japan at 24%, South Korea at 25%, and India at 26%.
Okay.
Interestingly, the United Kingdom has a proposed rate of 10%, which, matches that baseline tariff on all imports.
Right, the baseline.
And then there's some countries facing even higher rates,
Right.
like Cambodia at 49%,
Whoa.
South Africa at 30%, and Indonesia at 32%. This reflects the particularly high existing tariffs they have on American goods.
Wow, those are some really significant differences. So it really does seem to be tied to the existing trade landscape with each of those countries. Now, here's where it gets really interesting for a lot of people. The automotive sector, what's the deal there?
Yeah, the automotive industry is facing a particularly substantial tariff. Starting on April 3rd, 2025, there's a 25% tariff on all foreign-made automobiles imported into the United States.
25%.
And this isn't just about complete vehicles like sedans, SUVs, and light trucks. It also includes key auto parts like engines, transmissions, and electrical components.
Okay.
The report even suggests that this could potentially expand to include even more parts down the line.
A 25% tariff on cars and parts, that's going to ripple through a lot of industries and potentially hit consumers hard. But the report mentions a way for some importers to potentially lessen that impact.
Yes, that's the opportunity related to USMCA compliance. USMCA stands for the United States-Mexico-Canada Agreement.
Our trade deal.
Our free trade deal with our North American neighbors, exactly.
Yeah.
Importers of automobiles who can demonstrate the U.S. content of their vehicles and parts may be able to ensure that this 25% tariff only applies to the value that isn't from the U.S., Canada, or Mexico.
Okay.
This is clearly designed to incentivize production and sourcing within North America.
Okay, so a bit of a break for our partners in North America. Now let's talk about steel and aluminum. We've seen tariffs in these areas before, haven't we?
We have, yes. A 25% global tariff on steel and aluminum imports has actually been in effect since March 12, 2025. So this wasn't entirely new. However, the report highlights an expansion of these tariffs that took effect on April 2nd. This expansion now includes things like empty aluminum cans and even canned beer.
Canned beer, too.
Canned beer.
Yeah.
What's also significant is that this effectively raises the tariff on aluminum from an initial 10% that was imposed earlier. The administration's rationale, according to the report, is to further protect domestic producers, close any loopholes, and address countries they see as having excess production capacity in these materials.
So even the cost of your favorite canned beverage could be affected, huh? Beyond these measures that are already in place or about to be, what other potential trade actions are being discussed in the report?
The report mentions a few areas where the administration has signaled potential future action. These include possible tariffs on lumber, pharmaceuticals, and even copper imports.
Copper. Interesting.
With the report noting the strategic importance of copper in defense, infrastructure, and emerging technologies.
Lumber, pharmaceuticals, copper, that really covers a wide range of essential goods. And then there's a potential for a very specific and potentially painful tariff aimed at European wines and spirits.
Yes, the report details the possibility of a rather hefty 200% tariff on European wines, champagne, and spirits.
200%.
However, this is specifically tied to whether the European Union moves forward with its own tariffs on American whiskey. So it appears to be a targeted retaliatory threat in the making.
Wow.
Imagine the impact on your next bottle of Chianti.
A 200% tariff that would definitely get some attention and maybe change some buying habits. And finally, the report touches on potential tariffs on oil and gas imports.
That's correct. There's consideration being given to a 25% tariff on oil and gas imports from countries that continue to purchase these commodities from Venezuela. This seems to be more closely linked to broader foreign policy objectives rather than purely economic trade concerns.
Okay, so that gives us a really good picture of the landscape of these proposed tariffs. Now, let's shift our focus to what all of this might mean for the economy here at home. What are the main domestic economic ripple effects that are anticipated?
Well, the report suggests that a general consensus among economists is that we're likely to see a slowdown in GDP growth. Tariffs essentially increase the cost of imported goods for both businesses and consumers. Think of it as an added tax. This can reduce how much people can buy, which in turn dampens overall economic activity.
So higher prices leading to people buying less, and that dragging down overall growth. And the report also raises concerns about a potential recession.
Yes, the concern about a potential recession is definitely present, especially if these tariffs trigger significant retaliatory measures from other countries, leading to a full-blown trade war. The uncertainty created by these policies can also make businesses more hesitant to invest in new projects and hire more people, which can further contribute to economic stagnation. Uncertainty is really the enemy of business confidence.
Absolutely. What about inflation? We've certainly been dealing with higher prices lately. How are these tariffs expected to play into that?
Inflation is a major worry. By making imported goods more expensive, tariffs can actually worsen existing inflationary pressures. Businesses that rely on components or materials sourced from overseas may have no choice but to pass those higher costs on to their customers. The report specifically points out sectors with complex global supply chains. Think about how many different countries might be involved in making your smartphone or your car, as being particularly vulnerable to these price increases. What's interesting is that while the administration might argue that tariffs could eventually lead to lower prices by encouraging more domestic production, the immediate and widely expected impact is inflationary.
So higher prices first.
Exactly. Which could really complicate the Federal Reserve's decisions about monetary policy, potentially forcing them to raise interest rates to combat this tariff-induced inflation, which could then, further slow down the economy.
So these tariffs could really box the Fed in. Now let's think about jobs. We often hear the argument that tariffs will bring manufacturing jobs back to the U.S. What does this report suggest about the likely impact on employment?
Well, the report presents a nuanced view, acknowledging both sides of this argument. Those in favor of tariffs believe they will incentivize companies to manufacture goods in the U.S., thus creating domestic jobs.
The protectionist argument.
Right. They might point to instances where tariffs in the past led to increased investment in specific industries, like steel. However, many economists are more skeptical and suggest that the overall impact on employment could actually be negative.
How so?
Well, for example, industries that rely on imported materials might face higher production costs, potentially leading them to reduce their workforce to stay competitive.
Okay.
The report even refers back to studies of the tariffs from the first Trump administration, which found that while some sectors like steel production did see some gains, downstream industries that use steel as an input often experience job losses. It really highlights how interconnected different parts of the economy are.
It sounds like it's rarely a simple equation of tariffs equaling more jobs. Okay, let's turn our attention to the global stage. What kind of international responses and trade tensions are we anticipating or already seeing as a result of these U.S. tariffs?
Well, the announcement and implementation of these U.S. tariffs have definitely caused a stir among our key trading partners. China, perhaps unsurprisingly, has already implemented retaliatory tariffs on a range of U.S. goods.
Already,
with a particular focus on agricultural products. Canada has also expressed strong opposition, with Prime Minister Carney stating very clearly that Canada intends to retaliate against what they see as unjustified measures.
Okay.
Mexico has also indicated that they will be putting in place their own countermeasures.
So it sounds like the initial dominoes of retaliation are already falling. What about our allies in Europe?
The European Union has announced a two-pronged approach. First, they will be reinstating tariffs on U.S. goods that were in place during previous trade disputes in 2018 and 2020.
Bringing back old tariffs?
Exactly.
Yeah.
Following that, they plan to implement additional tariffs on other U.S. exports. This clearly signals a significant and coordinated response from the EU.
It really does sound like we're on a path towards increased global trade friction. And what role does the World Trade Organization, the WTO, play in all of this? Are they likely to step in?
Well, the report points out that the WTO's ability to effectively resolve these kinds of trade disputes is currently facing some uncertainty, particularly given some recent challenges to its dispute settlement mechanisms. This lack of a clear and universally accepted international arbiter could potentially make it more difficult to de-escalate these trade conflicts.
That certainly adds another layer of unpredictability to the whole situation. Now, you mentioned looking back at the 2018-2020 tariffs. What were the most important things we learned from that period that could give us some insight into what might happen now?
Yeah, the analyses of those earlier tariffs offer some really valuable lessons. The general findings were that they led to higher prices for American consumers, effectively reduced their real income, and had a negative impact on overall U.S. GDP. The agricultural sector was particularly hard hit due to the retaliatory tariffs imposed by our trading partners.
Yeah, I remember that.
And as we discussed with the steel industry, while some domestic industries might have seen initial benefits, the industries that rely on those now more expensive materials often suffered, sometimes leading to job losses that outweighed any gains. It really highlighted just how interconnected the global economy is and how tariffs can have unintended and negative consequences.
So, the evidence from the recent past doesn't necessarily paint a rosy picture of the likely outcomes of these new tariffs. Now, a key argument we often hear in favor of tariffs is that they are necessary to address the U.S. trade deficit. What does our report say about the effectiveness of tariffs in actually achieving that goal?
Well, the report acknowledges that the administration views the long-standing trade deficit in goods, which has been a feature of the U.S. economy since 1975, as a primary justification for these tariffs. The argument is that they are needed to encourage domestic manufacturing and reduce our reliance on goods from foreign adversaries. However, the report also presents the prevailing view among economists, which is that tariffs are generally not a very effective tool for reducing overall trade deficits.
Why not?
Well, factors like the relative strength of a country's currency, as well as the complex and interconnected nature of global supply chains, often play a much larger role in determining trade balances. Tariffs alone often get offset by these other economic forces.
So, while the stated goal might be to shrink that trade deficit, the actual results of these tariffs in that regard are likely to be limited, and economists are generally quite skeptical of that approach.
Okay, we've covered a lot about the tariffs themselves and their potential economic consequences. Now, for our listeners who are thinking about their investments, what are some key strategies they should be considering to navigate this new tariff landscape? Yeah, given the significant uncertainty and the potential for increased volatility in the markets, the report suggests several important investment strategies. The most fundamental is diversification.
Always.
Spreading your investments across different types of assets, different sectors of the economy, and different geographic regions. This is a basic risk management principle that becomes even more important in times of economic uncertainty like this.
Diversification, always a good foundation. What else should investors be thinking about in this environment?
Sector rotation is another strategy that might be worth considering. This involves shifting your investments away from sectors that are likely to be negatively impacted by the tariffs, for example, companies with significant international supply chains, or those that export a lot to countries that are likely to retaliate
Right.
with their own tariffs. Conversely, you might want to look at sectors that are considered more defensive and less sensitive to trade disruptions, such as healthcare, utilities, and consumer staples, the things people need regardless of the economic climate.
That makes sense, moving towards potentially more stable areas. What about focusing on companies that are more focused on the domestic market?
Absolutely. The report suggests that companies that are primarily focused on the U.S. domestic market, especially smaller and mid-sized firms that don't rely heavily on international supply chains, could be relatively better positioned to weather tariff-related disruptions.
Okay.
They might even see increased demand if imported goods become more expensive. So, a bit of a buy American approach in your investment thinking, perhaps.
Okay, so focusing on the home team. And what about the potential for market volatility? Should investors be prepared for some ups and downs?
Definitely. Investors should anticipate potential volatility across various asset classes, stocks, bonds, commodities. The report also notes that during periods of heightened trade tensions, we often see increased demand for traditional safe haven assets like gold and high-quality government bonds,
Safe havens?
as investors look for places to park their money during uncertain times. So yeah, brace for some potential turbulence.
Okay, bracing for some potential turbulence in the markets. And finally, how crucial is it for investors to stay informed about any further developments in this trade situation?
Staying informed is absolutely critical. Investors need to closely monitor any announcements of new countermeasures or retaliatory tariffs from other countries, as these actions can have a significant impact on global trade and investment flows.
Right.
The report emphasizes the need to consider different scenarios based on how broadly these tariffs are ultimately implemented and to be prepared to adjust investment strategies as the situation evolves. This isn't a static situation, it's likely to keep changing.
Solid advice: stay informed and be ready to adapt. Okay, we've covered a huge amount of ground in this deep dive, from the nitty-gritty details of the new tariffs to their potential economic and global repercussions, and finally, some important considerations for investors. Let's try to summarize the key takeaways for our listeners. What are the most important things you'd want them to remember?
Okay, yeah. The key things to keep in mind are the sheer scope of these new tariffs. With that baseline 10% impacting almost all imports, alongside the significant and varied tariffs targeting specific countries. We've also discussed the very real potential for both domestic economic consequences, including slower growth and increased inflation, and the likelihood of escalating trade tensions on a global scale.
Definitely.
It's really important to remember the lessons from the previous round of tariffs, which suggest that the promised benefits often don't fully materialize, and the costs can be widespread and affect many different sectors.
Right, those downstream effects.
Exactly. And for those thinking about their investments, diversification, being aware of sector-specific risks and opportunities, and staying closely informed about developments are all crucial for navigating this uncertain environment.
Absolutely. It's clear that this is a really significant shift in U.S. trade policy, and the level of uncertainty surrounding its long-term effects is, well, substantial.
Indeed. And it really leaves you, our listener, with a significant question to consider. Given how deeply interconnected the global economy has become, how might these tariffs ultimately reshape not just the relationships between trading partners, but also the broader landscape of innovation and long-term economic competitiveness? Not just for the U.S., but for all the countries involved. Think beyond the immediate headlines and economic forecasts, and really consider some of those less obvious longer-term consequences that might unfold.
A really thought-provoking question to end on. Thanks so much for joining us for this deep dive. We hope this has given you a much clearer understanding of this evolving tariff landscape. Until our next deep dive.